Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Do dividends really matter? Well, in the past week, we saw the big news of Sasol cutting its dividend, as in completely, gone, disappeared. Unless they have met a specific net debt target, there will be no more dividends. Now, we have to assume at some point they will meet that target, so don't panic too much. But this did get me thinking that it is worth spending some time on supernatural stocks, delving into dividend policies and whether they actually matter. So let's start with the most fundamental question of all, which is around whether or not dividends do in fact matter. In theory, if the company has the ability to reinvest the capital at a rate that meets the required return on equity for investors, then there is no need to pay dividends. The company can just take your money and do good stuff with it. They don't need to give it back to you. In fact, because of the tax leakage in dividends, in that situation, it would actually be better not to pay dividends. It's not even an equal situation. It is better not to pay them, not to incur the taxes, to rather go off and reinvest it and compound the share price accordingly and create great returns. That is the theory, anyway. Speaking of theory, here's another one for you, the bird in the hand theory. Now, this suggests that investors prefer dividends to potential capital gains. If this is true, then everything I just said was rubbish about the company needing to retain the money to rather go and reinvest it. Also, if it is true, then it stands to reason that a company that pays dividends will enjoy a superior valuation to one that doesn't. Tesla has never paid a dividend in its life, yet it trades at a valuation multiple that is completely divorced from reality. Thus, the bird in the hand theory probably needs some work. There's also an argument that dividend policy should depend on what type of stock we are talking about. A hardcore growth stock suddenly declaring a large dividend is practically an acknowledgement of defeat, because the market would interpret this as the company running out of reinvestment ideas for the capital. At the other end of the spectrum, a slow-growing, boring old cash cow deciding to cut its dividend and invest in some risky project instead will almost certainly cause chaos among shareholders and much panic that the directors have simply lost their minds. But what if paying a dividend actually became the right decision for Tesla? And what if that boring old company suddenly does have an interesting use for the funds? Are the companies tied into those dividend strategies forever because they've been put in a specific bucket? In the case of Tesla and the crazy multiple that it trades on, it's honestly anyone's guess what the share price would do in response to the decision to pay a dividend. It has such a cult following that I would not be shocked at all to see long glowing blog posts about the newfound maturity of Elon Musk and how he's such a great guy that he's now rewarding investors, even though most growth stocks are punished by the market when they start paying dividends. I think Tesla is quite an exception. This punishment inevitably comes in the form of a vastly decreased valuation multiple, as the market has to go off and recalibrate its growth expectations, taking that signal of a dividend as meaning, hey, we don't have enough reinvestment opportunities here, so rather you take the money, dear shareholders. But back in the real world, and specifically the boring old company, the decision to materially change the dividend policy is likely to be met with initial pain in the share price. This is exactly what we saw in Sasol this week, as the share price sold off in response to the news that the dividend policy has changed substantially. Not only is the first test the level of net debt on the balance sheet, and a rule to not pay a dividend unless they are below a certain level of debt, but there's also a change to how the dividend will be calculated once they've met that threshold. Instead of paying out a percentage of headline earnings per share or HEPS, it will be a percentage of free cash flow. The thing you need to understand about free cash flow is that this is the cash flow generated by the company after its capex expenditure. In an asset-heavy business like Sasol, this means that dividends just got a whole lot harder to predict. For investors who were sitting in Sasol for the dividends, that's a huge problem, and many of them probably ran for the hills. So is that bird in the hand theory? Or are we still back on the dividend irrelevance theory that was developed by Merton Miller and Franco Modigliani in the 1960s? The bounce back in the Sasol share price surely gives us a clue here that perhaps they were onto something back in the 60s, surrounded by cars that were truly stunning and certainly far more exciting than what we see today. There's obviously plenty of noise in the Sasol price and many factors that influence it daily, but there's no denying that it bounced back solidly after the initial dividend shock. So why is that? Because that makes it sound like the dividend doesn't actually matter. Well, it's quite likely that investors with less of a focus on dividends saw that the management team is actually trying to prioritize a stronger balance sheet, and they liked that. It's not that Sasol is hanging on to the money so they can go and do more exotic deals. No, they are actually just trying to fix the balance sheet. The truth of it is that stubbornly paying a dividend when the balance sheet is in trouble really is foolish. You can either take some pain now or a lot of pain later. Another good example is MAS, the real estate fund that cut its dividend recently in a super proactive step to try and manage the challenges coming down the line when debt needs to be refinanced in what is surely going to be a far less accommodative credit environment. For a property fund to cut its dividend is a massive decision, and it led to a huge sell-off in the shares. They have subsequently partly recovered, suggesting that even the property sector has investors who are happy to look past the dividend and understand what their capital gain potential looks like. Personally, I think that dividends have largely become a marketing tool, especially in the US. The concept of a dividend aristocrat gets used and abused. I've dug into many of those companies before, and it's quite obvious how they manage to pay a higher dividend every single year. They simply have an artificially low payout ratio. When you are paying out a modest percentage of profits as a dividend, you can easily increase that dividend even in a year of underperformance, as you just increase the payout ratio that year and then let it normalize the following year. If you consider dividends plus share buybacks by those companies, then you'll see that earnings are just as erratic as you would expect to see. The difference is that share buybacks are the buffer rather than cash dividends, as those companies will do just about anything not to lose dividend aristocrat status. We see a version of this in South Africa as well, where companies will sometimes have flat results but the dividend goes up. That's just an example of the payout ratio moving higher. I'll leave you with one further thought on this, which is that the bird in the hand theory becomes extremely relevant when the company is investing in suboptimal projects. In that case, you would certainly rather have the dividend, wouldn't you? But perhaps you then need to ask yourself why you've invested in that company in the first place. If you are so worried about them having your capital to play with, then hoping that the dividend will save your investment is like putting a band-aid on a wound that is screaming out for stitches and a visit to the emergency room instead. Be very, very cautious of making investment decisions primarily based on dividend yields. Dividend policies can change, and you need to understand why that is happening. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.